This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Given optimistic earnings forecasts and stretched valuations by just about any measure, the bar is high for significant further stock gains, at least in the short term. But stretched and potentially pricey does not equal pending bear market. So up next, let's think about some of the differences and why gains of some degree are still a reasonable base case. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director here at the Wise Investor Group of Raymond James. Great to be with you as always. Kind of a sloppy week, right? A little bit of up, a little bit of down. There was a lot of anxiety around what the PCE indicator would be for the most recent month. That's the inflation measure that the Fed tends to pay the most attention to. What we saw was essentially a number that came in line with expectations and kind of reinforced the fact that it's going to be a lumpy move from high inflation to lower inflation. I don't think that's any source of debate at this point, but the trend is still down. In fact, I think it's 12 months in a row where the PCE has come in lower on a month-to-month basis. But regardless, it was a sloppy week and probably not unexpectedly. Because, like I said, not only did you have that data, but we're also coming off a pretty darn strong period in the markets. I mean, roughly the S&P has gone up about 23% over the last 17 weeks. Pretty aggressive move. That really out much. I mean, we had a little bit of a pullback, I guess, in January, maybe for a few days, but that was about it. And keep in mind, this is the third such period like this. I mean, if you go back to late 2022, remember the market troughed in October of 22. We had a rally off of that. Market went up about 20% in 16 weeks. Then we had a pullback. Then the market went up another 21% in 19 weeks, kind of late spring, early summer of last year. And then the most recent period. That's according to the Sandbox Daily. So the question is this the continuation of a strong surge, or is this kind of it? Well, let's talk about that a little bit. Obviously, we don't know, but we maybe can rely a little bit on historical precedent. By the way, before I get too much into it, I just read a great quote from the famed money manager Bill Miller. He used to be up at the Legg Mason for a long time. People often say there's lots of uncertainty, but when was there ever certainty in the markets, the economy, or the future? I'm just trying to understand the present. End quote. That's kind of the way I feel. We spend very little time trying to predict the future, much more time trying to understand the present realities and what it means for our portfolios. And I think that's probably a good way to live. Most people do the opposite. Most people spend all their time thinking about what's going to happen, very little time digesting what actually is happening. Big difference. Okay. But yeah, listen, a little bit of steam out of the balloon, not a surprise at all. Wouldn't be surprised at all going forward if we did have a pullback at some point. Remember, the stock market's averaged a couple 10% corrections a year going back 100 years, and we really haven't had one since late summer, early fall of last year. So, but if you look at it and kind of widen the lens a little bit, I was reading some good data from Ryan Dietrich. He's a blogger I followed for a long time. He looked back, I think he went back 100 years, I believe, and looked at when the market starts strong with both a positive January and February, like we've had so far this year. Well, as we've been talking about in recent weeks, strength tends to beget strength. Over the last 100 years, we've been higher in 26 out of 28 instances for the remaining 10 months of the year, and higher 27 out of 28 times for the next 12 months, with an average gain, or median gain, I should say, of almost 12%. That's, again, according to Ryan Dietrich. That's pretty darn good batting average. 27 out of 28 times for the next 12 months. So, yeah, sure, we could get a pullback at any time. It won't be a linear ride, but that's some pretty good evidence that momentum like we've had, really going all the way back to October of 22, generally begets more momentum. And remember, and I've already quoted this data before, maybe a couple weeks ago, but according to FactSet, what happens after markets make a new all-time high like they did this year after a year without one? because remember, the prior high was back in January of 22. So again, a new high after a year without one. Well, going back to 1954, according to FactSet, the markets are always higher a year later. The only exception was 2007. And that was after housing had peaked, subprime mortgages were defaulting, and of course the great financial crisis was going to start. So past performance is no guarantee of future results, as we all know, but ask yourself this, is this year more akin to 2007 or most other markets where new all-time highs were made? I would kind of be in the latter camp. You know, our friends at Strategas quote them a lot on this show. They've kept this for a long time. I think I've been following this data from them for at least 15 years, maybe longer. But they do what's called a bull market checklist. It's conditions that were present at other major tops in the market. And of course, in recent history, they looked at the dot-com bubble top in March of 2000 and the pre-financial crisis top in 2007. So 2000 and 2007. And looked at a number of things that were present then to see if those same things are present today. Now let's run through some of these. A blow-off top. And what they mean by that is a period of extreme euphoria where the market's surging and everything's going up. You certainly saw that in spring of 2000. And you also saw it in 2007. You're not really seeing it today. Yes, I know there's some euphoria around, chip stocks and chip stocks related to AI more specifically, but you're definitely not seeing it in a wide swath of the market. You're not seeing it in energy, staples, utilities, REITs, healthcare. I mean, pockets of exuberance, but certainly not widespread. Heavy inflows into equity mutual funds. The average investor coming back into the market in droves. We're not actually seeing that. Net inflows into equity mutual funds and ETFs are underwhelming, specifically with reference to or compared to money markets. More money is going into more money is going into cash funds and money markets than there is into stocks right now. And that's been the case for 7-8 months now. How about a big pickup in M&A activity, mergers and acquisitions? Nope, not seeing that right now. Same thing with the IPOs. Barely seeing any new companies come to market right now. I don't want to say it's dead, but nothing like we saw in 2000, 2007, where companies were lining up to sell their stock to people at inflated prices. You're not seeing that. Rising real interest rates. And by real, I mean rates relative to inflation. Well, the more inflation comes down, as I talked about a minute ago, the more restrictive real rates become. For now, they remain below levels seen at the start of recessions. And that's true both on the short end and for 10-year treasuries. So we're not seeing rising real interest rates. And we're not seeing weakening upward earnings revisions. Earnings revisions are actually turning higher again. Analysts have taken their estimates up for the rest of this year and for 25. Normally not what you see at those blow-off tops. How about an erosion in the number of stocks making new highs? Really not seeing that either. Often at the peak of the market, you see narrowing leadership. You've seen it a little bit. I mentioned some sectors are not really participating, but we've started to see financials do a little better, biotechs do better, healthcare in general doing a little better. We've actually seen more breadth in the market over the past 4 months than we did in the previous 8 or 9 months. Are we seeing a shift towards defensive leadership? That's often something you see at market tops. No, as I just mentioned. Utilities have underperformed. Consumer staples have underperformed. Healthcare, yes, doing a little better, but has still underperformed over the last 4 or 5 months versus growthier sectors. There are a few others, but I think you get the point. Things can change. Things can change on a dime, but based on what we know today, we're just not seeing a lot of the conditions that we've seen right ahead of other major declines, 30, 40% type declines plus. Of course, things can come out of the blue. We saw that with COVID, right? We saw a 35% drop in the markets, with COVID, and that was something that wasn't even on any people's radar, a few months before then. So, again, this is not a foolproof way to look at the markets, but anybody who's out there saying, we're about to have an impending collapse, there just isn't a lot of evidence for that. By the way, let's say you're right. Let's say there is about to be an impending collapse and that what goes up has to come down. Let's say you believe that. All right, well, if you actually look at some of the data it's not necessarily something that should scare you away. And I know that sounds weird to say, but I read a piece from Ben Carlson the other day. Everybody knows that have you invested at the absolute trough of the financial crisis, which was March of 2009, you've made a mint since then. I mean, the S&P's up something crazy like, I think it's like 900%. Don't quote me on that, but it's something close to that since March of 2009. But Carlson looked at what happens if your timing was really lousy. What happens if you invested in the S&P at the peak? So the peak in 2007, right before the collapse started. So I think that was summer of 2007 was the peak, or maybe it was a little later. Maybe it was October of 2007. Well, according to Carlson, if you invested in the peak in 2007 and didn't do anything else, you just kind of left your money there, you still are up roughly 350% on the S&P from that time through about a week ago. So obviously, as we've been saying, no two conditions, no two periods are exactly the same, but I think you get the point that even if your timing is really bad, if you do have a longer-term perspective, it may not be quite as bad as you think. But so I've talked a little bit about that sort of the historical precedent for maybe stocks continuing to do well, even if we do get a short-term pullback. I will say, though, that valuations are sending a bit of a different story, maybe a more cautionary story, because, quite frankly, market's pricey. Market's pricey by just about any historical perspective. So I think it might make sense to kind of look at the relationship between valuations and stock prices. Are they as tightly correlated as a lot of people suggest? There's a guy named Richard Russell who I followed. He's one of the main guys over at Dow Theory Letters. You probably heard of the Dow Theory before. Great quote. The stock market always does exactly what it's supposed to do, but never when. And I think that's a really good way to look at it. So when you're looking at valuations, it's a pretty good referendum on future returns. If you have some idea of what earnings could be, which again I know is a bit of a leap. Trying to predict earnings is pretty difficult as well. But let's say you could kind of predict earnings. Valuations have some way to predict future returns, but you have no idea when. Stocks can stay expensive for a long period of time. Stocks can stay cheaper than they should for a long period of time. So it is valuations in general and thoughts around valuations are a rough, blunt tool at best. But the reality is markets, give or take, depending on who you listen to, somewhere between 20 and 21 times earnings. This is at the index level. Obviously, there are individual names, individual sectors. There's a lot of variance within that. But at the index level, somewhere between 20 to 21 times. And again, looking at the data from Strategas, when inflation has been in this range, somewhere between 2 and 4%, the average over the past 50 years has been about 17.5 times earnings. When interest rates are in this range, somewhere between 4 and 6%, the average PE is about 19.5. This is going back to 1953, so more than that, 70 years. So by both of those metrics, the market is in expensive territory. But if you look at the kind of the current market multiple, the valuation multiple, and future returns over various time frames, what you'll find is over short periods of time, like less than 12 months, it's anybody's guess. I mean, the scattergram is all over the place. This is according to FactSet. FactSet shows that there's basically no correlation between valuations and returns over the next 6 to 12 months. Okay, so the fact that the market's at 20 times, 15 times, 25 times really doesn't say anything about stock prices the rest of this year. However, you go out further, and by further I mean 5, 10 years, there is a high correlation between starting valuations and future returns. So that's why places like Vanguard, a lot of these, big investment shops are taking down their long-term expectations for stock returns. So you got to keep that in mind. So, I mean, again, it's not a reason to sell stocks today, but it is a reason to maybe temper your enthusiasm if you're thinking about really loading up on stocks, changing your allocation in favor of more risk. I would really, it's not advice, I would just say think about that. Okay, think about that. But I will say that earnings expectations have been going up. Analysts have been revising their estimates higher. In fact, consensus right now, according to FactSet, is calling for about 11% earnings growth for the S&P this year, and then another 13% in 2025. So that's why I said at the very top the bar is high, because if we're at 20 to 21 times earnings, and that is relying on earnings growing at a double-digit clip both this year and next year, anything that kind of falls short of that, I think is a little bit problematic for the broad averages. I mean, in other words, the market's almost relying on perfect execution. And I think what I would say about that is we're going to need participation from some other areas of the market. I mean, if you look at the most recent quarter, again, I'll reference FactSet data. If you look at the Magnificent Seven, we've talked a lot about the Magnificent Seven. They did almost all the heavy lifting. The Magnificent Seven in aggregate had 58% earnings growth this quarter. You ask about the other 493 stocks in the S&P, earnings fell 2%. Fell. So, it's pretty obvious that if we're going to get, 10 to 13% earnings growth over the next couple of years, you hope the Mag 7 keeps going, but you'd like to see that broaden, right? You'd like to see some other areas, financials, healthcare, energy, pick up some of the slack. Kind of last thing I'll say on this is earnings. I'm kind of talking more about earnings here because, we talk about a lot of other things, right? I was just talking about valuations. People talk about the Fed. We've talked about interest rates. We've talked about inflation. All these things are important, but nothing is more important than earnings. Going back to Ritzold Asset Management, Ben Carlson for a second, he put out a really good piece looking at where did stock returns come from in various decades. And what I mean by that is, did it come from earnings growth? Did it come from changes in valuation? Did it come from dividends? And what is pretty eye-opening is how much of the returns on a decade-by-decade basis have come from earnings. So, for example, in the 2010s, so 2009 through 2019, dividend yield was about 2%. These are annualized numbers. Earnings growth about 10.6%. Valuations only went up 1 percentage point. That's it. Yet stocks had 13.6% annual return. So what's that? 80 to 85% of the return came from earnings. A smaller percentage from dividends, very little from PE change. How about so far this decade? So far this decade, stocks have averaged, give or take, just shy of 12%. Dividends, only 1.6%. Price to earnings ratio, yes, it's gone up, but only 2.5 percentage points, not as much as maybe some people think. Earnings growth's been almost 8% this decade on an annualized basis. So again, most of the return going back, 14 plus years has come from earnings growth. Keep that in mind going forward. That is going to be the main thing to look at. Again, people are talking about inflation, the Fed, elections. All these things are important. All these things are influential to some degree, but none of them are going to be more influential than earnings. And that's why, when economic data comes out and shows that, inflation is slightly up, yet employment's resilient, spending's resilient, all these things are resilient, I pay more attention to the resiliency because at the end of the day, I think we're better off with better earnings than a Fed aggressively cutting rates. And that's why, and again, we'll talk about this some other time, but things like profit margins, the abilities of companies to harness AI and drive productivity, those things are going to be very important going forward because they could provide companies the opportunity to be more efficient, to be more productive, even in the face of higher interest expenses, higher labor costs, other offsetting factors. So that's going to be the focus. Just a couple other things kind of on the stock front. We've talked a lot about market concentration, right? The fact we talked about the Magnificent Seven, and I just mentioned how in the most recent quarter they were responsible for almost 60% of the earnings growth. Excuse me, they had 60% earnings growth. The rest of the market had negative earnings growth. So they were responsible for the lion's share of the overall index earnings growth. But it's something we really need to pay attention to is the concentration. You really need to make sure you understand what you own. I'm going to mention NVIDIA for a second. And I'm not making a judgment call on NVIDIA. It's not a stock that we have that we purchased for clients in the portfolio. We may have a few clients who have it, but it's not something we've bought at the book level. Full disclosure, I have a little bit myself. And when I say a little bit, I think it's less than I added it up the other day. It's like 0.4% of my portfolio. So hardly moving the needle. You can judge whether that represents a conflict of interest. But I'm really just bringing up NVIDIA to make a point. If you look at their quarter, it was arguably one of the best quarters we've ever seen. Literally, I'm not exaggerating. Their revenues came in at about $22 billion, give or take, for the quarter, for the fourth quarter. Get this, that's up 265% year over year. I don't know if we've ever seen a growth rate for, we've certainly seen small caps with that type of growth rate, but for a company of that size to grow that much, almost unfathomable. And they raised their guidance for the next quarter by $2 billion ahead of expectations. These are big numbers, right? Their net profit margins continued to expand, hit almost 56%. Their net income was up 769% over the last year. These are numbers according to Creative Planning. And guess what happened? Well, they come out with that news. The stock price goes up a lot, obviously. That led to a market cap increase in one day of $277 billion in one day. So obviously the stock price has done well, and deservedly so. But when you're looking at NVIDIA, I think you really have to pay attention to what is now embedded in expectations. So if you look at consensus forecasts, this is going back to FactSet data, analysts are now suggesting that annual revenues are going to go from about $60 billion in the most recent fiscal year, almost a double by 2026. Okay, that would be an unprecedented amount of growth for a company of their size, literally unprecedented. Put it this way, they do, like I said, about $60 billion in revenues in the most recent fiscal year. Amazon, in the most recent fiscal year, I think did about $575 billion in revenues. Google/Alphabet, about $307 billion. Okay, so they're not even close to the size of Google and Amazon on a run rate basis. However, they're trading at over 41 times sales. 41 times. Google's at only 6 times sales. Amazon's roughly 3 times sales. Again, this is based off of FactSet data. So it's not that NVIDIA hasn't done an unbelievable job in their execution. It's that to justify that type of valuation, they had to keep doing it, and they have to keep accelerating, essentially ad infinitum. So the market's essentially assuming that they're going to have 70 to 90% market share, for years, almost indefinitely. History tells us that when you have a great product, when you have a great opportunity, a great market, it invites competition. Yeah? So I'm not sitting here telling you that NVIDIA can't do it. I'm not even telling you that NVIDIA is a bad investment. I'm not saying that, because anybody who said that's been an idiot. But I am telling you, know what you own. Understand what expectations are baked into the stock price. Okay? And the reason this is very important is because we continue to see money concentrate not only in the Mag 7, I would argue so far this year, it's down to like the Mag 2 or 3. Apple's negative for the year. Google's basically flat for the year. Tesla's negative for the year. So money is now concentrating in literally a handful of stocks, okay, at the mutual fund level, the ETF level, the hedge fund level. In fact, the earnings contribution to the S&P of the Mag 7 is about 13%, give or take. The sector weight is almost 20%. Anytime you see the earnings contribution a lot less than the market cap weighting in the S&P, often a sign that maybe things have come a little too far, a little too fast. I was reading, about hedge fund exposure, and I'm trying to remember where I saw it. I think it was from Goldman Sachs. Goldman Sachs was talking about how the typical hedge fund generally has about 70% right now, 70% of its long portfolio in its top 10 positions. That's the highest concentration ever seen in hedge funds. So it's not just at the mutual fund level, it's at the professional investor level. Meanwhile, also according to FactSet, if you look at the S&P 1500, which is a very broad index, covers, of course, the entire S&P 500, but also the S&P 400, which is mid-caps, and the S&P 600, which is small caps. So it's a very broad measure of U.S. stock market health. The S&P 1500, almost 55% of the constituents in that index have had a negative return since the Fed started hiking rates, which was almost exactly 2 years ago, March of 22. So I think you get what I'm saying. So much of the market is now going in the direction of a handful of names. I think a quarter of the return in the S&P this year, so far this year, has come from NVIDIA. Meanwhile, a wide swath of the market has done diddly squat the last couple of years. So you can take that however you want to take it. You could say, hey, listen, I got to chase what's working. Or you could decide that, hey, listen, maybe I want to be aware of my exposure if you're in funds or ETFs that maybe have overexposure to some of these areas, and maybe think about spreading out some of your risk. That's all I'm really saying here. That's certainly something we've done at the Wise Investor Group level, okay, by having balance in other sectors, other areas that we think could have some promise. Up next, stick with me. I want to kind of harp on that point and talk to you about a few individual names that have reported or been in the news recently that we think deserve your interest and attention. Back in a minute.
Will the Magnificent Seven continue their spectacular run? Be careful relying too much on last year's playbook. Tune in every week to hear Simon Hamilton and Chase Henderstein discuss the latest financial trends and what investors need to know. To learn more about some of the most important planning topics to consider and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
As I was just saying before the break, the market has become continually and increasingly concentrated. That's not to say that we haven't seen some broadening in the market. As I mentioned at the top, we've seen healthcare start to do better, particularly small cap biotech, some of the farms doing better. We've seen some financials start to pick up. So we have seen some broadening. But in terms of how people are positioned, and by people, I mean everybody from professional traders like hedge funds to mutual funds, ETFs themselves, like sector ETFs, a lot of them are heavily concentrated in a handful of names. You just have to know what you own. Not saying you shouldn't own them, just understand what you own and realize that if you own multiple funds, for example, multiple growth funds through multiple carriers, you might think you're diversified. If you look at the top 5, top 10 holdings and the weights in those funds, you might own the same thing in multiple places. So understand it. So where else might you go if you're looking for some opportunity? I've been talking a bit about the consumer staples space recently. It's been a very poor performing sector, not necessarily on an absolute basis, but certainly on a relative basis. I spoke, I think, a couple weeks ago about the fact that staples have had some of their worst performance relative to the S&P 500 in something like 40 years. What's also interesting, and I saw this in Strategas the other day, they've gone, this was about a week ago, consumer discretionary stocks have outperformed consumer staples for almost 273 days. Doesn't mean they've outperformed every day, but for 273 days, you've seen discretionary do better than staples. It's one of the longest streaks we've ever had. It's only been 3 or 4 streaks longer than that in the last 40 years. So again, it could get worse before it gets better for people owning consumer staples, but it may be the time to start looking at some of these names. I've talked about Mondelez before, symbol MDLZ. You may not know the name, but you know the products. Their flagship product is Oreos. We all know Oreos, but just hit the $4 billion revenue run rate just in the last quarter. Chips Ahoy, Cliff Bars, they bought Cadbury several years ago. They're the largest consumer staple focusing on sort of cookies, biscuits, sugary snacks, candy, pretty much in the world. It's a name that we own for our client or many of our clients in our portfolios. It's also a name that I own personally. So remember, assume if you're a client and that you have it, that we've done a lot of due diligence and we've determined that it's a good fit for you and your objectives. But if you're not a client, you really need to do your own research. And again, I own them personally. My family owns Mondelez. You have to decide for yourself whether that represents a conflict of interest on my part. But Mondelez, if you look at their most recent quarter, it was a bit of a disappointment. So the stock has been outperforming their benchmark. So if you look at them relative to the consumer staples sector, they're up roughly 12%. 12% better than the sector as a whole. So they have been an outperformer, but their most recent quarter was not great, mostly on the top line, the sales line. You know, they've had a pretty consistent long-term growth algorithm, and they actually lowered that algorithm for the next 12 months. In Mondelez's defense, what they've been saying is that these are short-term, non-recurring, mostly operational issues. So, for example, they, with their Cliff Bars, you know, the Cliff brand, you've probably seen those in 7-Elevens and CVS's. They had kind of a one-off situation where they changed out an operational logistics system, and that caused a disruption in distribution for a while. And then it took a while to negotiate price increases in Europe. That also disrupted some of the distribution. So according to Mondelez management, these are not long-term systemic issues for Mondelez. I think the real story with Mondelez is their geographic positioning. They had the largest emerging market exposure of any of their competitors. Almost 40% of their sales are in emerging markets. And not to generalize too much, but those are generally markets that are not affected by Ozempic and weight loss drugs and people wanting to eat less sugary snacks. These are markets where there's an increasing demand for those types of products. So they're not only in the right categories, but they're in the right geographies. Very clean balance sheet. Their cash flow, free cash flow, grew 20% year over year, and they've had 11 consecutive years of dividend increases. So it's not the cheapest stock in the world. It trades in line with Pepsi and Coke and Procter & Gamble, but in general they've had superior growth rate relative to those companies. So take a look at Mondelez. I think the risk factor there is that so far, the last few quarters, they've been able to continue to increase prices, and their consumers, their distributors, and their restaurants and distribution outlets that they market to, grocery stores, I should say, have accepted those price increases, both here and in Europe. The risk is that, that may not happen going forward, and they may have to cut prices. But so far, that has not been the case. That would probably be the biggest risk factor. But take a look at Mondelez. And of course, you all know Coca-Cola. Symbol KO, household name. They reported their earnings, and again, I think there were some shorter-term issues that kind of obfuscated the fact that they had a really impressive quarter. Their long-term organic revenue growth targets have been in the 6 to 7% range. They came in at about 12% year over year. 12% in terms of top-line revenues. That's pretty darn good. I think the reason why the stock didn't do a whole lot is, on the bottom line, almost entirely to do with currency translation. Coke, like a lot of these big consumer staples companies, they do a lot of their business overseas. They have to translate those foreign sales back to the dollar, and a strong dollar has really hurt those profits. So that's probably a good 4 to 5 percentage point headwind on the bottom line. So that's why Coke, their earnings growth doesn't look as great as it has been. It also is a reason why this stock doesn't look as cheap as it probably would be on a currency neutral basis. But the actual operations are really impressive, and they're putting a lot of money back into the business. That's what I'm kind of really interested about from Coke's perspective. I mean, if you look at what they're putting into innovation, particularly in reduced sugar or zero sugar products, bottled waters, also really exciting relationships with alcohol companies. They're doing a lot of mixed beverages, sugary alcohol drinks, things like that, or fruit alcohol drinks. They're partnering with people like Constellation Brands, Diageo, and I think that's an exciting area of growth for them. So, again, the risk to Coke is probably the same as the risk to Mondelez, that they won't be able to pass through cost increases in the way that they have in the past, or price increases in the way that they have in the past. Of course, there's the additional risk, even more so than Mondelez, of continued dollar strength, which would hurt the bottom line. But Coke is not unreasonable at this point from a valuation perspective, trading at less than 20 times earnings. You look at the history on Coke, it's one of the cheaper multiples that they've traded at going back a decade. So both of those stocks look kind of interesting. And by the way, in both of these cases, I'm pulling all this data from FactSet. In fact, their earnings data, their revenue data. So I'm going to give FactSet credit. I want to go in a different sector, a sector that's been fairly maligned, and that's real estate, REITs. We all know what's going on with commercial real estate in general, glut of obviously corporate office property, people working from home. We all kind of know that story. But I think everyone's been painting that sector with the same brush, and I think it's a little unfortunate because if we actually do get a Fed cutting rates and a little bit more interest in some of these rate-sensitive sectors like REITs and utilities, there's some opportunities there. One that stands out for us and one that we've been accumulating at the book level for our clients, and I own personally. By the way, I also own Coke personally, is VICI Properties, VICI. I'll give Goldman Sachs credit. They had a really nice write-up on their most recent quarter. What Goldman Sachs was noting is that they're one of only 2 publicly traded casino REITs. And the thing about the casino business is that the gambling licenses are tied to the real estate leases, the hotel leases. So it's not like you can just walk away from it, a hotel, even in a tough economy, because like COVID, of course, Las Vegas was shut down. They didn't have any disruption in earnings during that period. Literally no disruption. They had almost 100% rent collection. And that's because they can't give up the gambling license. Those are long-term licenses. So there's a lot of visibility into that side of the business. Goldman Sachs thinks there's pretty good visibility into 4% adjusted funds from operations growth over the next year. Plus, they pay almost a 6% dividend. So it doesn't mean the total return is going to be 10% because, of course, there are other factors affecting stock prices. But in terms of what's a reasonable expectation, the growth of the earnings and the growth of, and the dividend yield, that's not a bad base case. But the other thing is there's some pretty interesting growth opportunities, and that's where the delta comes in. So the stock will generally do better or worse as a result of how much growth they can find. They think there's a fair amount of opportunity within the casino community, specifically Vegas, but they're also diversifying into a lot of other things. And we've seen it here in the Tyson's Corner area. Tyson's 2, you had some failed department stores. That's been repurposed into an entertainment area, right? A bowling alley. We're seeing youth sports facilities spring up all over the place where they had batting cages and basketball courts and artificial turf fields and swimming pools. They are getting into a lot of other things like that. It's an additional high-growth income stream that I think looks very interesting. So if you're looking for kind of a little bit of a below-the-radar REIT that doesn't get a lot of media attention, that is not a play on shrinking commercial demand for office space, take a look at VICI Properties. I think could be an interesting name to kind of keep in mind. Of course, the risk factors are that interest rates either stay the same or go up, and people just don't come back into this space anytime soon, or the fact they just can't find any growth opportunities. Okay, so that, something that wouldn't allow them to grow those earnings over time. Those are probably the biggest risks. So Coke, Mondelez, VICI Properties, 3 interesting names that really haven't participated a whole lot in the market over the last 6 or 7 months. Not to say that they've gone down, but haven't offered a lot of upside. But if the steam does come out of the balloon and sort of the AI trade, the NVDA trade at some point, these might be 3 candidates to take a look at. Plenty of other names to talk about, but I'll save those for next time. As always, I hope this was helpful. I wish you good health. I wish you wise investing. Thanks.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.